In this video, I will show you 4 investing mistakes that prevent you from reaching consistent 20% annual returns in your stock market. And the first one is not often talked about on YouTube. So let's start from the beginning. The first mistake, if you want to invest in stocks for the long term, the first mistake is to invest in companies that don't care about you, the shareholder. This is not often talked about on YouTube. So what can I put here? Invest in a company that companies don't care. There are some companies that care about their shareholders. They mention it publicly and they said, okay, you are my shareholders, we are partners, I care about you and your money for the long term. We plan to compound at a healthy rate, not too fast, not too slow, healthy rate. Companies that don't care about shareholders. And there are companies that lie to shareholders. There are companies that adjust all the numbers, that cook the numbers. There are crooks in this world. We are living in this world. There are good people, there are bad people, and some bad people are CEOs of public companies. And if you don't know how to detect these bad people, you will be lied to. And that's how you can make a stupid mistake of investing in these stocks and losing a lot of money. So there are companies that really don't care about shareholders. What I mean is they give you a plan as a shareholder, the investor presentation, a guidance, and they change it a lot. They change their mind a lot. They don't have a consistent plan. And if they are asked some questions in the earnings calls, management will blatantly lie and get emotional on the call. I've seen this. I won't name names, but I've seen CEOs getting emotional on calls at the border of insulting the person. The analyst, that happens. That happens. And you see some interviews on YouTube of the CEO, and the CEO, that doesn't make any sense. They dilute shareholders all day long, and they don't care about their shareholders, their partners. They fund acquisitions with the shareholders' money through dilution, and this is absolutely something that you want to avoid if you want to compound your money in the long term. This is a stupid mistake, and this is quite subtle. If you don't do the work, you will fall into this trap. So the first trap, the first mistake is this one: investing in companies that don't care to shareholders. On the opposite view, there are companies that care about the shareholders. There are companies that when they mention a plan for the next 5 years, they deliver. They outperform everybody. They outwork everybody, and they are very happy to answer questions from the shareholders. When I was in 2022 in the annual meeting of Warren Buffett, Berkshire Hathaway, it was the first meeting since COVID, so first meeting in person. The first sentence from Warren Buffett, you can check this on the internet, is good to see you, my shareholders, my partners, my owners. We are in the same boat. You want to invest in companies where you are in the same boat. Like the CEO thinks about you. They don't want to lose you money. You lose your money, your precious money, your wealth, etc. There are management that thinks this way. And most of the time, this is also linked to everything I teach on my YouTube channel. Most of the time, the CEOs that don't care about shareholders, they focus on the short term. And most of the time, CEOs that care about the shareholders always talk about long-term incentives, etc. By the way, speaking about incentives, you can check if a management doesn't care about you. You can check a document online called either the annual report or the proxy report, and you can check the incentives for compensation packages for the management. In other words, the CEO may have a fixed salary and a variable salary. The variable salary may depend on certain metrics, KPIs. If you grow your revenue, you will get a huge bonus. Okay, maybe so. This is the KPI. The revenue, the salary, is linked to the revenue. Maybe that is the case. Maybe not. Maybe instead of being linked to the revenue, it is linked to adjusted EBITDA or a non-GAAP metric that is completely made up that you can cook, or only the shares count or something else. I've made a video about capital allocation. I'm talking about this compensation package, and depending on each compensation package, you will get the vision for the management. If a CEO is paid with the variable part of the salary based on efficiency and margins and return on invested capital, you can bet that they will do everything to increase margins, efficiency, return on invested capital. They are paid more so they can buy a huge house, a huge boat, and on the contrary, you have some companies, I won't name names, that focus on completely adjusted numbers, non-GAAP metrics, things that you can modify, cook, cheat on, everything in case. Okay, so that was for the first point, and I have fallen before in this trap of investing in companies that don't care about the shareholders, and I won't do this anymore. In case you're new to this YouTube channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade with a performance of 25% per year, and the goal of this YouTube channel is to make you a better investor. The goal is to make you an intelligent investor. Okay, let's continue with the second point. I have some notes here. Oh yeah, okay, obviously the second mistake is the FOMO, the pure FOMO. And most of my viewers on YouTube are serious retail investors. They know what FOMO is, fear of missing out, and they all say, yeah, I won't be a victim of FOMO. This is much more subtle than you think. FOMO is what we are seeing right now with AI names. FOMO is an expectation that 2025 will look like 2024 that already looked like 2023 with Nvidia going to the moon, and now we have a new president in the US. You may argue the same phenomenon will happen for Bitcoin, that it will go to the moon. This FOMO is a pure change of reality. In other words, on average, the S&P 500 generates 8 to 10% per year. In 2023, it was 25% per year. Now we are in 2024, the S&P 500 is doing 25%. And if you doubt what I'm talking about, please check the 1990s. It all started with some fundamentals improving, and it turned out to be a giant bubble. I'm not saying that there is a bubble now, I'm just saying that there is maybe a reversion to the mean happening. If things don't continue with profitable earnings, huge growth, if things start to tumble a little bit, it will be hard for a lot of stocks. So don't be a victim of FOMO, fear of missing out, saying, okay, this will continue for 2025, 2026. Let me buy now because it's going up and up and up. I can't miss the train. I can't. And if it has an elevated price, that's even worse. You can get expensive price. If you are FOMOing into a stock with an expensive price, that's how you make a stupid mistake. You know that stocks can trade at ridiculous valuations. There are stocks at a PE of 50, 60, 70, 80, 90, PE of 100. If you buy a company now with a PE, a price earnings ratio of 100, and you think it will continue to go up because it has gone up before, I would advise you to check on the internet the average return for a stock trading at 100 times earnings. Most of the time you have negative returns. In other words, if you buy at such a high price, it is very likely that you will lose money. That you have exceptions here and there, but on average you lose big money on this one. And if there is a misstep in management, or they miss the guidance, they miss the analyst estimates for a certain quarter, the stock can lose 20% in one day. And then if they don't manage to turn the ship around in the right direction, it can also lose again 20%. So you lost 20% and 20%, let's say 40%. That's how you can lose a lot of money very, very stupidly. So if I have a second advice for you, second mistake to avoid is to absolutely refrain from FOMOing into stocks, and most importantly, doing the FOMO for expensive prices, expensive stocks. You can FOMO maybe where the valuation is not excessive. That's a relatively minor mistake. But if you FOMO into an expensive stock, that's not bad luck. That's just bad judgment here. Okay, third mistake. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Over-diversification. Let me write it. Over-diversification. So that's the reverse of a concentration. Diversification. Oh, sorry for the bad writing. That's when instead of owning a portfolio of diversification, I don't know how to write. Okay, let's say it's over diversification. It will be much more simple. It's instead of having 20 stocks in your portfolio, you own 100, 200, 300, and you think to yourself, yeah, I'm safe. But I'm telling you, yes, you are safe, but you will never outperform the market. It's too hard to monitor 300 stocks. It's way more simple to monitor all the quarterly earnings for 20 stocks, 30 stocks. Having too many stocks is not a gain anymore. You are not an institutional fund. You are not a hedge fund. You are a retail investor. If you watch this video, I hope that you are a serious retail investor having some money to manage. Over-diversification will not help you. It will crush your performance. You will pay a lot of fees, transaction fees. And if you have a winner, something that generates 3x, 5x, 10x, it will only be 1% of your portfolio. So it won't make you rich. So you are very likely to be, as you say, an index sucker. So you follow the index closely and you can't outperform. So over-diversification, that's how you make a stupid mistake. Diversification. I don't know how to write this. Okay, this is stressing me out. I will write it again. And I would advise that the opposite may not be true. Over concentration may not be such a high mistake, because people that don't own a lot of stocks, let's say 3 stocks, that's very, very concentrated. Let's say 6 stocks. Maybe they have a concentrated portfolio, but they know that it is high risk, high reward. And if you only keep companies with strong balance sheets, profitable, etc., I would say it's a better risk reward, because you know these 6 companies really well, you know them really well, and you have a very high chance of outperforming the market if they are good companies. Okay, let me spend 10 seconds writing this good word. Come on, Chris, you can do it. That's a huge word. Cation. Okay, congrats. You managed to write a word. Over concentration is not as big of a mistake, I would say. Over diversification is where you can lose a lot of money on the opportunity cost basis. Maybe you won't lose much money because you have 300 stocks, but your opportunity cost is huge. Most of my viewers on this YouTube channel, we are approximately 40 years old. So let's say you are between, by the way, 99% of the listeners, viewers are male, between 30 years old and 50 years old. So you have time with you. You can invest for, again, 30 years, 40 years. You are young. You are not in your 80s. You have time. And the price you will pay over diversification is huge, because you will not outperform the market if you have 300 stocks. So it will make maybe a difference of 1%, 2%, but every year. And if you compound for 30 years, 40 years, 1% difference is huge. You have this snowball effect, and the discrepancy is increasing over time. So this is some big mistake that is very subtle. All these mistakes are subtle, because you won't see it as a mistake, but it's a huge mistake. So because you will say, okay, yes, I'm underperforming, but that's okay. That's okay. No. You had the opportunity to outperform, but you didn't seize this opportunity. You knew how to analyze stocks, how to build a portfolio, but you didn't want to take much risks. So this is a huge mistake that I see over and over, and people think that they are safe with over-diversification. And you know what Warren Buffett says? Warren Buffett says that diversification is protection against ignorance. It means if you don't know anything, buy everything and you will be fine, because if something loses, if something goes bankrupt, you're fine because it was only 0.2% of your portfolio. Congrats. But this is a channel of stock pickers. We want to outperform the market. We want to pick the best stocks. We want to build the best portfolios that will outperform for the next 3 years, 5 years, 10 years. This is what we do. We don't want to have 300 stocks. So that's it for this third point. By the way, that's also what I teach my students in my coaching program. We don't focus on over-diversification. We want to concentrate portfolio, maybe not 6 stocks. By the way, I have 15 stocks, so you get the idea. So if you have between 10 and 20 stocks, you're fine. You can monitor everything. You are an expert on your companies. You can build a strong watch list in the meantime and build your watch list of great companies over time, buy them at a great price, monitor them at a distance, and that is how you make a lot of money. That is how you outperform the market, not with over-diversification. Damn, I don't know how to pronounce this word correctly. Okay, and the last mistake for you is obviously trying to time the market. So market timing. Okay, again, this is subtle timing. Wow. Okay. Let's say it was written properly. Last mistake, timing the market. It's saying to you, now the market is overvalued. I will sell because I will buy cheaper in 2 months, because I think because of this person will become president, and you have this in China and you have this in Argentina. This will change, this will impact the market and the US dollar, and the markets will go down. So let me sell right now because I think in the beginning of 2025 I will be able to buy cheaper. You know what? The market doesn't care if you think like this. The market doesn't care if you think it's overvalued or not. We've seen this not too long ago, 2021. The market went up, it was overvalued, but it continued to go up and go up and go up. We had a small decline in 2022, minus 20%, and went back up in 2023, 2024. The market is not waiting for you. And maybe in 2021, in this situation, you thought that the market was overvalued with a PE of 30, 40. So you sold at the top. Congrats. But that's only one fraction of the equation. Because when you time the market, you have to first find a good timing to sell. Second, find a good timing to come back to the train, to jump back in, so to buy. And I have countless examples of people that said, wow, in 2021 the market is overvalued, let me sell, I will buy when it's cheaper. I think we are headed into a recession, inflation is high, we will have some conflicts now in Europe, that's a mess. So they sold. Congrats. And markets went down 20% in 2022. They waited, they didn't buy back again because they hoped that there would be a 50% decline. So you are greedy and you want to buy cheaper and cheaper. So when markets go down, you say, oh, it will go down even more. It goes down 15. You say, okay, maybe it will go 30%. The market goes down 20% and you are greedy. You said, okay, see how it's going down. I was right. Let's hope for 40% decline and I will buy when everybody sold. Perfect timing. And the market jumps back up and it goes really fast. And you see that all the losses we had in 2022 faded away in 2023 with AI, with technological advancements, with innovation and earnings. And for the same example for stock picking, I mean, you have this famous example of Meta platforms that crashed 70% in 2021, 2022, and people were greedy. And you can go on Twitter, there are still tweets of people saying, I will buy this when it reaches $30 per share, $40 per share. I mean, guys, the stock was down 70%. You think Meta platforms will really go down 90%, 95%? This is still a profitable company with the same CEO, the same vision, etc. So people are very greedy. This is on the movie called Wall Street. Greed is good. Greed is part of being human. People are greedy, and all the guys that time the market, that try to time the market, are all greedy. That is my take on this one. It's much more humbling to just ride the wave. And what does Warren Buffett says about market timing? It's you gotta keep swimming. If the tide is with you, you keep swimming. If the tide is against you, so meaning the stocks go down, bear market, you keep swimming, you keep investing. The process is the same. Either when you have a bull market or a bear market, you want to buy great companies when they are trading cheap. That's it. You don't care if we are in a bull market, bear market, in certain times, all the markets are good. Just find great companies at a good price and keep investing for the long term. Timing the market or trying to time the market is a stupid mistake, and all these 4 mistakes are why some people, a lot of people, can't have a great performance in the long term. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.